we've got a lot going on in the market right now, and you started at the beginning of 2023, which was not the best year financially for a lot of people. How did you see that impact some of the people that you've been coaching? Would you say that you've had to, decrease budgets, things of that nature? How did the economy, change how you were interacting with clients? And then how do you see it progressing moving forward? Because the Fed has announced that they have 3 potential rate decreases happening. What are you going to, tell your clients, and what kind of pivots are you thinking about making for 2024?
Yeah, and this is a whole other hour episode on it by itself. But so just to quickly set the stage, June of 2022, inflation was 9.1%.
Yeah.
Which means from 2021 to 2022, the cost to live went up 9.1%. Okay.
Right.
So then from June of 2022 to June of 2023, inflation was 3%. So people are like, oh, well, inflation is going down. No, it's just getting worse, slower. So, and that stacks. So prices went up 9% in 2022. Prices went up another 3% in 2023. So over a 2-year period, your dollar lost 12% of its value.
Correct.
Okay. So the middle class is getting crushed. They're getting absolutely crushed because wages have not kept up with this cost of living increase.
Yes.
And we can argue there's some ironclad reasons why inflation happened. We can again talk about that another time, but it's here.
Yeah.
Okay. So the reality is people's savings is the lowest in recent history. 401k hardship withdrawals are at an all-time high, meaning people are borrowing on their 401ks to pay for their life.
Consumer debt.
Well, credit card debt hit $1 trillion in the Q3 of 2023 for the first time ever. It's now currently $1.3 trillion. So we're up 30% in just a few months on credit card debt, which, by the way, is at the highest percentage APR because of interest rates being high. So people are getting hit everywhere. And so the interesting thing is consumer spending and consumer confidence is still at a consistently high amount. So that mismatch between people outspending their means is going to come to a crash sooner or later. And it happened for a lot of people in 2023. Okay? So people were taking out HELOCs to pay off their credit cards, which mathematically makes sense, but risk absolutely does not. You're borrowing 10% to pay off 30%. Mathematically, hey, we did something. But what happens when you don't pay your credit card? You get angry calls from some guy at a collection center. What happens when you don't pay your HELOC?
Your house
you lose your freaking house.
Your house is
okay.
gone.
So this is not a safe way to continue personal finance. Okay. So again, to set the stage, middle class is getting crunched. Okay. And Warren Buffett famously said, when the economic tide is high, everyone looks good, everyone's floating, everyone's looking like a genius. When the tide goes out, you see who was swimming without any underwear on. Okay. There was a lot of people without underwear in the end of 2023. Okay. So unfortunately, our class is built to prepare people for any economic situation. So, halfway through, three-fourths of the way through 2023, when people realize like, my bank account's lower than it's ever been, I feel the crunch, I'm staying awake at night worrying about money, that helps people come to us, which, we don't love that that's the situation, but it's just reality, right? And by the way, we're there to help. So my message to someone who got crunched and just destroyed by 2023 is let's learn from that mistake. Okay. Number one, you have to have savings. Okay. You have to have, again, the not sexy thing, right? You have to have at least $1,000 in a high yield savings because when life happens, you're going to have to slide your credit card. Okay. Period. Get that done. You've got $1,000 in a high yield savings. Boom. You're good. I want you to focus all of your efforts on paying off debt. And when I say debt, I mean consumer debt. So I'm talking cars, credit cards, not mortgages. I'm talking HELOCs, anything with a variable rate interest rate or something that is consumer oriented like credit cards, cars. Okay. Typically, we finance depreciating assets with those types of debt, which is why we separate good debt and bad debt. Good debt is houses, 0% financing on appliances and stuff. If you apply that money to investments, bad debt is anything consumer. The difference is these things go up in value typically, these things don't. So you're putting your money towards things that go down in value and then you have to pay interest on it. That's a double whammy. It's just it's got what we call financial gravity. So pay off all your consumer debt. Once you do, get 3 to 6 months of expenses, not revenue, expenses in a savings account. And if you're a business owner, I want you to do this for personal and for business. I want you to have a high yield savings for your business that is 3 to 6 months of operating expenses And then for personal, I want you to have 3 to 6 months of personal expenses and high yield savings. So you might be asking, like, that's actually going to take a while. It might take you 2-3 years. I don't care. Yeah. 2023 is going to happen again, and you will be glad you did that when, for some reason you get hurt and you can't run your business as a real estate agent, or you're just a normal 9-to-5er and you lose your job. Whatever economic things happen where you have hardship, you're going to be glad you have 6 months that you can pay your bills and not have to make any money.
Yeah.
Okay. And by the way, once you're there, the risks, by all investments carry risk. Okay. There's varying amounts of risk that you take.
Levels of risk. Yeah.
So to say to someone this is a risk-free investment is a lie. That does not exist. Okay. There's some inherent risk with all investing. Okay. So, but when you have no debt, consumer-wise, you have 3 to 6 months of expenses in business and personal. If you have a business, you are able to take more responsibility of those risks to chase that higher return without having to worry about paying your bills.
Yeah.
Okay. Once you are at this point, you're going to sleep better. Your food's going to taste better. Your relationships are going to be better. Your marriage is going to be better. Your friends are going to think like, yo, what happened to him? Like, you're just going to be at peace. Okay. And if that economic tide goes out, you're going to be better suited to take advantage, because that's when people who in down markets, people who are prepared for them make the most money.
For sure.
Okay. So the best thing that could happen for me is a horrible stock market and housing crash, because I could make millions of dollars from that. But it's horrible.
Buying opportunity.
Yes. Yep. It's horrible for 90+% of the United States, because they don't know how to play economic defense with their personal finances. And that's what we are all about, setting that bedrock before we advise anyone to take any sort of risk with investing.
Yeah, exactly. And that's important because, like you said, not a lot of people realize, but the economic downturn is when you make the most money on the upturn, because that's when you need to be buying. Whenever properties are selling at way lower prices because of 8-9% interests, then whenever the interest rates turn the other way, the equity goes to the roof. So that's what not a lot of people understand, but it's a really important thing to have dry powder to build up that savings, build up what your equity and things, so that if you want to make investments, for example, Target stock this past year took an absolute wham. I put some money into that and was up big time, and as well as plenty of other examples of things like that. You have to have some dry powder if you want to make some solid investments, because you make money on the buy.
Whenever 2020 happened, whenever COVID happened, did you unleash the vaults on it and buy as much stock as possible?
I was focused. Every extra dollar I had went towards buying houses.
Oh, that's right. You were buying houses. Sorry.
Yep, absolutely. Yeah. That's when I started buying houses. So I was working, as a nurse and recruiting for Momentum, building that. Every dollar I had was going to buying houses.
Right.
And I definitely don't regret that.
No, for sure.
My biggest financial mistake I ever made was when I bought my first house in 2017. And I was still very locked into that scarcity, like white knuckle mindset. I was, I think, 24, 25. I put $90,000 down on my first house.
Why?
Because I was Mr. Dave Ramsey. I was like, I don't want any debt. I don't want a mortgage. So I'm like, I saved up all this money through investing and just managing money well. Put $90,000 on my first house. This is 2017. Had I bought 4 houses with that, I would have $1 or $2 more million in net worth.
You didn't.
That's my biggest financial mistake. But that's the takeaway of, you can be too safe also.
For sure.
You can be too safe. And so my message again to people is, get to a point where you can take calculated risks, but you also have to know how to do it too.
Yeah.
And to your point, not everyone knows to watch Target stock. And so that's where we come in, is to educate people to get to that bedrock to where you're safe to make risks. You've taken care of your debt, whatever, you're ready. And then we educate people on how to take advantage of the market, because the majority of people don't know.
Yeah.
Just because it's not taught, and it's just the reality. They don't know how to take advantage of a 2020 or a Target stock downturn. They just don't know. And that's where we come in.